What's happening? What is happening, everybody? Welcome back to Be Crypto Savvy, where we are trying to help the normal regular Joes like myself learn to be crypto savvy. Before we continue, I do just want to mention that nothing here on this channel is ever financial advice, but rather our personal thoughts and opinions that we are sharing for entertainment and educational purposes only. Now, with all that boring stuff out of the way, you are here and you have found our second installment in our Trading Tools series, where we are going to help explain some basic charting indicators, oscillators, profiles, and patterns. These videos will be grouped together to make referencing them for our audience easier, as well as allowing myself to be able to link these videos to future episodes where and when specific tools are used. So if you do happen to learn something from any of our videos, why not consider subscribing and to stay up to date with our future videos. So with all that out of the way, let's get into the second video where we will be talking about moving averages as well as the MACD. So first things first, let's talk about moving averages. The moving average is used in technical analysis to analyze the average price point over a specified length of time. By using the average, traders are able to help confirm trends or reversals and also kind of help smooth out the quicker price fluctuations that happen throughout the length of time, and that's able to help make price predictions. There are different types of moving averages we won't be getting into in this particular video, but rather we are going to focus on two different moving averages. Those two types are the SMA and the EMA. So we've got, whoop, give me my marker. Give it to me. So we've got the SMA. So your SMA is what's called the simple moving average. This is simple because when using the SMA, it simply takes the closing price from the specified length of time that you're requesting, and it averages out with each piece of time holding the same weight in the calculation. So just to kind of explain that, we are currently on the daily time frame. If I wanted to use an SMA over, let's say I wanted to use a 20-day moving average. So the SMA would use the previous 20 days, the price that that day closed at, and it would average out over that 20-day period length of time that I'm requesting. So that is your SMA. On the other side, you can also choose EMA. The EMA is what's called the exponential moving average. The exponential moving average uses the same concept. However, instead of placing equal weight on each piece of time, the EMA places more weight on the more recent time periods. So if we had that same 20-day moving average that I was talking about with our SMA, but we were using that with our EMA, the EMA would hold more weight on the more recent days and less weight on the days farther back in that 20-day time period. That's your difference between the SMA and EMA. So the choice between using the simple moving average and exponential moving average ultimately depends on your specific needs and trading preferences. So again, the difference between the SMA and the EMA is that the EMA gives more weight to recent price data, while the SMA treats all price data the same. This means the EMA may be more responsive to recent price changes and may signal a trend reversal faster than the SMA. However, the choice between using the SMA and EMA depends on your trading strategy and goals, and the SMA may be more appropriate for long-term trends, while the EMA may be better suited for more short-term. Many traders will actually even use them together for a better picture of the overall market and the trends. So ultimately, the choice between using the SMA and EMA should be based on your specific trading goals, risk tolerance, and the specific asset you're charting may even come into play. So with all that being said, let's actually throw these onto our chart a second so you can actually see what they look like. Alright, if you are following along, jump up to your Indicators tab and you can type in Simple Moving Averages. I've actually thrown it onto the home screen, which all you have to do is click the star and it will be front and center for you next time or whenever you need it. So go ahead and add that to your chart, which I actually already had it. So let me turn this on so you can see it. Now, the Simple Moving Average, like we said, applies the same amount of weight across all data points for the specific time that you specified. Now, jump over into the settings for your SMA and go to your inputs. For me specifically, the three that I will typically use are the 50, the 100, and the 200, and typically I don't even use the 100. Majority of the time, it's only the 50 and the 200. So currently I have mine set up as 50, 100, and 200 with the 100 currently turned off, which you can see if I just click right here, it throws that third line on there. Typically I have my 50 set as green and my 200 set as red, and then if you click on those boxes you can also change the opacity of the line. You can change the thickness, the color, so on and so forth. So that just kind of helps you keep track, especially if you do add in multiple other lines. You can change the thickness, you can change the color, you can even change the style of the line in the second box back here, which another way that I will sometimes look at this is throw on the histogram, which if we apply that and get this box out of the way, you can see where the histogram now is showing our moving average in this capacity versus just a line. So play around with that and kind of see what works for you and what your specific needs and the best way for you to visually see your chart. So let's go ahead and I'm going to just go ahead and change this back quickly to line, apply those changes. Now I'm going to turn off my SMA by clicking this eyeball, and I'm going to turn on my EMA. For you, if you are following along, just go up to your Indicators tab again, type in EMA, and it will bring up your options. There are different options, so you can kind of click and test and see which ones you specifically like the best. I have added this one to mine. I'm going to turn this on here. And I'm going to actually jump back into settings to do the same thing. I set mine up as 50, 100, and 200. Currently the only ones that I have on are the 50 and the 200, set up the same exact way. 50 is set up as green, 200 is set up as red. For the majority of my charting, my specific go-to is the EMA. That's just the personal preference for me. And when I have mine set up, typically what I like to do is I will set up my first EMA at the 50, set it up as green with a thin line. Then for my 200, I'll set up as red, and I'll change the thickness of the line to the next option up, just to help visually keep track. The 200 is bigger than 50, so the line is slightly bigger. It's just a quick way to mentally know, especially when you're first starting to use these, so you don't have to constantly check to remember what color you correlated with what number. That's where changing the thickness of the line may help. Again, my thicker line is my 200 and my slightly thinner line is the 50. To keep things simple for now, we're going to leave the moving averages right here, and we will now talk about MACD. So MACD stands for Moving Average Convergence Divergence, which is used to measure the momentum of an asset's price. It's typically calculated by subtracting the short-term moving average, which is normally set up as 12 periods, from a longer moving average normally set up as 12 periods. The result is then plotted on a chart with a third line called the signal line, which is normally a 9-period exponential moving average of the MACD line. So I know that's kind of some unneeded information, but just to kind of explain it properly. Now, before we go further, let's just go ahead and toss that onto our chart. So if you are following along, just jump up to your indicators tab and you can type in MACD for MACD and it will pop up. Go ahead and hit the star if you do end up liking this tool, as I did. So I'm going to click here and add this to my chart. Now we can see that this one here is on the bottom, and the MACD is used to identify buy and sell signals based on the crossing of the MACD line and the signal line. When the MACD line crosses above the signal line, it is considered a bullish signal, suggesting the asset's price may be about to increase. So down here, this blue line right here is what is called the MACD line. This orange line down here is the signal line. So whenever the MACD line, your blue line, crosses the signal line in an upward direction, that's used to signal a bullish move is possibly coming. So if you look down here, you can see where the blue line is underneath the orange line and it comes up from underneath and crosses in an upward direction. So let's put our line right where this crosses and move up. You can see that this was on this candle right here, and since then we've gone up several $1,000s on Bitcoin. And again, this is daily time frame. You can always jump down to, let's go down to the 4-hour time frame. On the 4-hour time frame, you can see back here on the 15th, we actually had the MACD cross underneath the signal line, which would be the opposite. And you can see that we came down a little bit after that move. And right here on the 23rd, or I'm sorry, on the 17th, you can see that we crossed in a bullish move, which on that date right here, we made this bullish push. So this is a tool that is definitely something that I like to use, and I had mentioned in the other video how a lot of indicators are what is called a lagging indicator, which it tells you things that have happened already, where this is something that helps try and identify trends before they begin. So I had mentioned about how the bullish signal with the blue MACD line crossing above the signal line was that bullish signal. So conversely to that, when the MACD line crosses below the signal line, it's the sign of the possible bearish momentum, and suggesting that there's a possible price decrease coming. You can also look for divergences between the MACD and the price of whichever asset you are charting, which can also provide additional insight into possible trend reversals. And I think I'm actually going to leave this video at that. Remember, if you got anything from this video, please toss it a like. And if there are ever any questions, feel free to add them in the comment section below, and I'll always make sure to get to those. At any rate, that's going to do it. We'll see you in the next video.